The Money Flow Index, MFI, is an oscillator that uses both price and volume to measure buying and selling pressure. Created by Gene Kwong and Avram Sudak, MFI is also known as volume-weighted RSI. MFI starts with the typical price for each period. Money flow is positive when the typical price rises, buying pressure, and negative when the typical price declines, selling pressure. A ratio of positive and negative money flow is then plugged into an RSI formula to create an oscillator that moves between 0 and 100. As a momentum oscillator tied to volume, MFI is best suited to identify reversals and price extremes with a variety of signals. As a volume-weighted version of RSI, the Money Flow Index, MFI, can be interpreted similarly to RSI. The big difference is, of course, volume. Because volume is added to the mix, the Money Flow Index will act a little differently than RSI. Theories suggest that volume leads prices. RSI is a momentum oscillator that already leads prices. Incorporating volume can increase this lead time. Kwong and Sudak identified 3 basic signals using the Money Flow Index. First, chartists can look for overbought or oversold levels to warn of unsustainable price extremes. Second, bullish and bearish divergence can be used to anticipate trend reversals. Third, failure swings at 80 or 20 can also be used to identify potential price reversal. Overbought and oversold levels can be used to identify unsustainable price extremes. Typically, MFI above 80 is considered overbought and MFI below 20 is considered oversold. Strong trends can present a problem for these classic overbought and oversold levels. MFI can become overbought, which is greater than 80, and prices can simply continue higher when the uptrend is strong. Conversely, MFI can become oversold, which is less than 20, and prices can simply continue lower when the downtrend is strong. Kwong and Sudak recommended expanding these extremes to further qualify signals. A move above 90 is truly overbought and a move below 10 is truly oversold. Moves above 90 and below 10 are rare occurrences that suggest a price move is unsustainable. Admittedly, many stocks will trade for a long time without reaching the 90/10ths extremes. The chart on the screen shows a stock that became oversold when the Money Flow Index moved below 10 in late October 2009 and early February 2010. The preceding declines were sharp enough to produce these readings, but the oversold extremes suggested that these declines were unsustainable. Oversold levels alone are not reason enough to turn bullish. Some sort of reversal or upturn is needed to confirm that prices have indeed turned a corner. The stock confirmed the first oversold reading with a gap and trend line break on good volume. The stock confirmed the second oversold reading with a resistance breakout on good volume. The chart on the screen shows a stock became overbought when the Money Flow Index moved above 90 in late September and late December 2009. Extremes in MFI suggested that these advances were unsustainable and a pullback was imminent. The first overbought reading led to a sizable decline, but the second did not. Notice that the stock peaked with the first overbought reading and formed lower highs into October. The late October support break signaled a clear trend reversal. After the December overbought reading, Arrow moved above 23 and consolidated. There were 2 down gaps and a support break, but these did not hold. Price action was stronger than the overbought reading. The stock ultimately broke resistance at 24 and surged back above 28. The second signal did not work. Failure swings and divergences can be combined to create more robust signals. A bullish failure swing occurs when MFI becomes oversold below 20, surges above 20, holds above 20 on a pullback and then breaks above its prior reaction high. A bullish divergence forms when prices move to a lower low, but the indicator forms a higher low to show improving money flow or momentum. Based on the chart on the screen, a bullish divergence and failure swing formed in January to February 2010. First, notice how the stock formed a lower low in February and MFI held well above its January low for a bullish divergence. Second, notice how MFI dipped below 20 in January, held above 20 in February and broke its prior high in late February. This signal combination foreshadowed a strong advance in March. A bearish failure swing occurs when MFI becomes overbought above 80, plunges below 80, fails to exceed 80 on a bounce and then breaks below the prior reaction low. A bearish divergence forms when the stock forges a higher high and the indicator forms a lower high, which indicates deteriorating money flow or momentum. Based on the chart on the screen, a bearish divergence and failure swing formed in August-September. The stock moved to a new high in September, but MFI formed a significantly lower high. A bearish failure swing occurred as MFI became overbought above 80 in late August, failed to reach 80 with the September bounce and broke the prior lows with a decline in late September.